Thank you so much indeed for asking me to come and speak at this annual event. The title of this lecture is, of course, Reforming the Banking Industry, which is so easy to say in just its 4 words, but so ferociously complex to even try to begin to do justice in the 45 minutes or so that I've got. And of course, we have been reforming the banking industry now for several hundred years, one way or the other. I think it's important to sort of have a look at what we've done. We've had a few adjustments here, we've had a few consolidations elsewhere, we've had a few rule changes, and of course we've had the introduction of technology, which has made a huge difference to the banking system as we know today. But Britain, as a result, is the capital of the global banking industry, and whose banks, as we know, combined balance sheets amounts to a figure of some 5 times our national GDP. But far from being a glorious inheritance, the industry is mired in scandal, undergoing a further period of in-depth scrutiny, accused of failing to function in a way that is expected by the consumer, and still suffering from a lack of liquidity as a result of a number of factors, including the possible imminent demise of the euro and the problems that face the banks on the continent. In any thoughtful analysis of the banking crisis, it's, I think, certainly worth looking at the historical context. You'll be pleased that I'm not proposing to go all the way back to Knights Templar or the Medicis of Venice to base my arguments, but to a period when I first had first-hand experience of the financial services industry as a blue button on the floor of the London Stock Exchange back in 1982. And this is a period when self-regulation ruled the day, and the regulation was, to a certain extent, through club membership. This meant that one of the main sanctions of infringement of any rules was actually being thrown out of the club to be a member of, and therefore you couldn't function, in the case of the stock exchange, as a stockbroker or a stock jobber. Respect amongst your peer group was an important asset. When I went up to the 24th floor of the stock exchange to take my authorised dealers test in 1983 or 1984, one of the rules written in the Stock Exchange Guide of Authorised Dealers was, an authorised dealer must never be seen as a man of straw. It is laughable in today's tight regulation, but then it was clear that anybody who wanted to be a part of the stock market had to be a man of trustworthy character. But there are also 2, I think, incredibly important factors underpinning the work of the London Stock Exchange and the way it was structured. And these 2 factors are talked about now and are crucial to the banking reform debate. The first is clear separation of responsibilities. The only way that you could transact shares, gilts and options was through the stock exchange. There was no real sort of OTC off-market or challenger market out there as an alternative. But importantly at the time, the stock exchange separated the risk between the 2 principal functions. If you were a member firm that traded your own balance sheet in order to perform your function as a market maker or stock jobber, as it was then known, you were under no circumstances allowed to have any contact with the consumer, be they private client or institutional. If you did have any contact with the consumer by way of being a stockbroker, you were under no circumstances allowed to take any proprietary risk on your balance sheet. And that ensured that at a time when there was quite a long settlement period, and thereby allowing the consumer to be exposed to counterparty risk, the consumer was not at risk ever from foolhardy trading activities of their selected broker. And the second important concept was the concept of liability, of risk-reward. All member firms of the London Stock Exchange, be they brokers or jobbers, had to be unlimited liability partnerships. Unlike the modern newly introduced limited liability partnership, and we certainly see this in the hedge fund world, the partners all had collective unlimited liability. Not only did that ensure the partners kept an eagle eye on the activities of their colleagues and staff, but they also had a vested interest in limiting risk. I believe there's no better risk management mechanism available than waking up with a cold sweat at 3 o'clock in the morning, realising that a commitment undertaken by you or one of your partners might result in something as horrific as your son being thrown out of Eton for unpaid school fees, or your daughter having her pony repossessed by the bailiffs at the pony club gymkhana at the weekend. Reputational disaster for an individual is incredibly important in addition to the obvious financial risk. But even as a blue button, we participated with this. Although I was told I could expect an annual remuneration of something in the region of £5,250 per year, the partners would only guarantee £3,500 of this, the remainder being made up of bonuses. Not only did this reduce the regulatory capital required by the member firm, but it also instilled a real sense of understanding of the risk inherent in the business and that you couldn't necessarily expect to do well every single year. And now surrounding the stock exchange, of course, were the merchant banks, investment managers, many high street banks, commercial banks, as well as a myriad of other financial institutions, all seeking to make the most of the opportunity the square mile presented. But underpinning the stock exchange was the concept of a minimum commission level on transactions, and this meant that brokers could only compete against each other on the basis of quality of product, not by undercutting each other and trying to beat each other on price. But in the early 80s, the OFT, I believe, ruled that minimum commission was no longer be allowed, and this precipitated what we now know as Big Bang. The argument went that if there is now a new element of price-cutting competition, it may destabilise the broking industry. So the broking industry asked, to be able to take positions on their balance sheet in order to mitigate that. From this successful argument, the concept of separation of brokers and jobbers collapsed, and from that, an overall acceptance that for all this to come together in any sort of meaningful way, that new capital needed to come into the industry. And this was the point at which the city went from what we knew in the old days to begin the journey to where we are today, with colossal conglomerates, universal banks, all of which try to do everything. And when they all do the same, they then have to try to invent new ways to do more. And what was interesting, though, was that we saw problems starting pretty quickly. It was in fairly short order that stories of firms losing significant amounts of money started to emerge. And perhaps we collectively missed an opportunity then to address this. James Capel was a very significant Asian broking firm that was taken over by the Hong Kong and Shanghai Banking Corporation, then at the time merely just a strong regional bank. And they, on a fairly regular basis, year after year, would take unwise positions in some issues or whatever going on throughout the Far East, and would quite regularly lose large amounts of money, much to the annoyance of the members of staff who were not given their bonuses. But it illustrated a change in the mindset. Suddenly the proprietors of these firms were now taking risks where they perhaps wouldn't have done before. But it would be wrong, I think, not to celebrate what happened. Whilst there are many lessons to be learned that may have been missed, the fact is this country grew into a major financial centre of the globe, seeing huge amounts of inward investments and exponential growth in the financial services industry. If I have any regret about what happened in the city, it is that the vast majority of the city is now dominated by global banks coming in and not necessarily by homegrown banks. However, regulation did respond, and from 1988 we saw the Basel rules being introduced, and they were there employed to regulate banks on a global basis, while the regulatory regime locally modified itself through an organic process of self-regulation. But as the industry grew and became ever increasingly competitive, the range of products on offer became ever increasingly complex. Moreover, the regulatory regime responded to the increasing complexity with increasing complex regulations. Interestingly, there were ever greater attempts to reduce risk by ever more complex rules initiated by a regulatory industry around it. This became in itself as a problem, as the interests of the regulatory industry, regulatory consultants, outsourced compliance departments, etc., thrived on ever-increasing complexity and so encouraged it. The result? Compliance and regulation became a hindrance to management and not a tool to effectively manage risk. But as a newly created investments bank grew and the city became a significant global player, these new banks had to seek new ways of making money. Much of this was done by investment banks offering non-risk services to their clients, such as prime brokerage, clearing systems, nominee accounts, agency transactions in relation to OTC products, that kind of thing. And the same broadly applied to the newly merged high street banks. Having access to the financial history of vast swathes of the population gives a bank an opportunity to expand their offering to customers. Financial services and other offerings sprang up, so much so that the consumer now sees their bank as little more than a product centre offering a sales force to try and sell product at the customer, and no longer as a trusted advisor that many people were familiar with prior to the early 80s. But this desire to seek ever greater returns on shareholders' funds meant that, for the investment banks, increasingly complex products were on offer, whilst big universal banks maximised shareholder returns by trading liquidity and balance sheets, and that liquidity in the balance sheets were provided by customers' activities and deposits. And remember, it's this trading expertise that was brought in under the Big Bang, so-called deregulation, that gave otherwise cautious banks and brokers, traditionally risk-averse, the knowledge to make the most of liquidity and balance sheet that the ever-growing banks were developing. And indeed, it's this cross-contamination that has arguably also brought in more aggressive practices in the retail banks from the wholesale banks. While multi-sell tactics are one thing between professionals, it is a whole different thing between professionals and consumers with little or no knowledge. And then, of course, we saw CLOs, CDOs, shadow bankings, and many associated services sprang up to the point where banks no longer resembled any familiar model rather becoming these huge conglomerates, the so-called universal bank. And indeed, many of these special investment vehicles that were created sprang up to get around the Basel rules. At this point, it seems, no one is really sure what is going on with the banking industry, and it seems, to our cost, not the regulators. But as the bubble grew and grew, as banks have become more and more innovative, those who are more traditionally managed, such as Lloyds, found that their share performance lagged well behind the other more aggressive banks, and the result that shareholder intervention was more likely to be critical about a lack of revving up the balance sheet in the event of a bank like Lloyds, as opposed to becoming complementary about prudence. So as we entered 2007, there was a toxic mix that comprised a number of elements that have resulted from Big Bang. A great deal of analysis has gone on this area, and there are many good books digging deep into the detail of the crash. Gillian Tett's book, Fool's Gold, is as clear a description of the role played by the shadow banking system and how the emergence of complex credit derivatives caused the problems I have read. Indeed, it highlights something that we didn't know before the crash, and that is that people did see it coming. It's just that they weren't listened to. In the haste to compete in a highly complex marketplace, where margins are ever finer and complexity is ever greater, so many corners were cut that increasing risk developed. But whilst we can dig ever deeper into the minutiae, as I spend my time looking at this as part of the Treasury Select Committee, as part of the Banking Standards Commission, I try to hold on to the simple elements that I think are incredibly important when analysing this. And it is these simple elements that affect behaviour and create the pillars from which thought and analysis can be formed. The first is the lack of separation of the consumer from principal risk that we enjoyed under the old stock exchange pre-Big Bang rules. But this is not just an obvious point of protecting the consumer from financial error and financial risk. It creates a cultural spirit that understands why the relatively uneducated consumer deserves a special place within an organisation. The second is the utter complexity of the regulatory system, the most recent iteration of which has been brought in by that champion of complexity, Gordon Brown, of the Financial Services and Markets Act 2000. Not only must the regulatory regime be simple to protect the consumer, it must be simple so the managers of banks, from board level downwards, see it as an effective tool of risk management and not a hindrance to its expansion and a blockage that needs to be circumnavigated. Thirdly, the reward system for staff that utterly failed to match reward with risk, brought about to enhance performance, but actually having the effect of creating adverse incentives and encouraging a culture that allows staff to seek personal gain at the expense of financial stability and the reputation and integrity of the institution they work for. And finally, the influence borne by frequently remote shareholders that are usually seeking quick returns, themselves in many cases rewarded with the same incentives as the Canary Wharf traders as they work in investment managers and indeed on trading desks, and who would seek highly leveraged balance sheets in the good time, but the opposite when it goes wrong, taking action not by advising the management of or the board of the bank, but by buying or selling the shares. And when the crisis struck, it seemed that adhering to Basel in the letter, if not the spirit, meant that banks could be Basel solvent but deep in crisis at the same time. Capital ratios did not serve to ensure liquidity in banks, whilst conduits and SIVs allowed huge problems to be brought onto the balance sheet while circumventing the rules. The first bank to blow up was, of course, a significant mortgage lender. Northern Rock was simply running a poor business model. And so when liquidity started to tighten, the banking community began to realise something was wrong. A bank borrowing short-term money and lending it long on a deposit advance ratio of around 5 times was inevitably going to find itself deep in trouble. And to add to the trouble, for a few days, no one was absolutely clear who was in charge of resolving the crisis, as a so-called tripartite system of regulation each one of the members of that tripartite organisation 2 opportunities each to pass the buck to somebody else. So we started with Northern Rock's collapsing. Within a year, Lehman's and Bear Stearns had blown up, closely followed by RBS, HBOS collapse, the contagion to Lloyds caused by the unfortunate decision of Victor Blank to take over HBOS. Barclays did their Middle East deal, the discovery that problems had spread to the insurance market with AIG problems, and the discovery of the colossal credit default swap market, with, if I remember correctly, £65 trillion worth of outstanding exposure, and no central clearing system to understand where any of this stuff was. And amongst it all, of course, an entire country went past. Iceland, as we all know, some of our costs hit the buffers. America responded with the troubled asset relief programme, whilst the British government bailed out RBS and Lloyds and started the quantitative easing programme. An analogy at the time used by a BBC reporter trying to explain what was going on was that the government's actions was rather like an oil tanker driving along beside a car that was trundling down the motorway with an incredibly badly leaking fuel tank and just pumping more and more petrol into this now sort of soon-to-be defunct car, hoping that the car would somehow manage to repair itself as it went along. And clearly, that was never going to be the case. So while quantitative easing pumped more liquidity into the system, the bank having cut base rates to 50 basis points, the reality is that we still have a huge amount of problems still. Public perception of the banks is still absolutely appalling. Labour frontbenchers, ever more enthusiastic to avoid taking any blame for the public finance catastrophe that we have inherited, are conflating public finances with the economy and blaming the banks and the coalition for everything they can. And I have to say, it's something they're actually doing rather well. Party discipline, I think, has worked extraordinarily well in the Labour Party, and they are doing, dare I say it, not a bad job of passing the buck. Vince Cable, whilst in opposition, talking about casino banks, managed, I believe, to utterly fail to recognise the good that investment banks can do in terms of raising investment capital for British and indeed global industry. And to cap it all, we seem to have a drip-feed of pre-crisis sparkles coming back to bite us now, the LIBOR scandal and the interest rate swap scandal. Now, to all of this, the government's response has, to my mind, I think, been both considered and appropriate. There have been, I think, relevant to this, 3 events. 2 responding to the crisis, and 1 responding to the drip feed of post-crisis bad news, and the continuing lack of trust. The Financial Services Bill, which is now in the House of Lords, where Lord Fight has now gone back to do even more beating up with it, is the response to the huge regulatory failings and addresses the architecture of the regulatory regime, as well as some very, very specific issues. The Vickers report, commissioned shortly after the election, reported last year, and the government's response to the Banking Reform Bill was published over the weekend. And finally, the Parliamentary Commission for Banking Standards, of which I remember, is underway, looking at both the overall picture of the banking industry, as well as performing pre-legislative scrutiny of the Banking Reform Bill. But of course, it's important not to forget the role played by our close and dearly loved friends and neighbours on the other side of the channel. Whilst we are doing our best to sort ourselves out, they are also struggling to resolve their very own self-imposed, self-inflicted crisis. The Eurozone collapse has been extraordinary, and from this we have also to keep an eye on what they are doing in Europe. Europe has published the high-level expert group on reforming the banking structure of the EU banking sector by Erkki Lehkonen, and this is their EU version of Vickers. On the 12th of September also, the European Commission proposed a single supervisory mechanism for banks, led by the European Central Bank, in order to strengthen the economic and monetary union. The set of proposals is a first step towards an integrated banking union, including empowering the ECB, modifying the framework for banking supervision, and communicating the Commissioner's overall vision for the banking union that includes a single rule book, single supervisory mechanism, and the next steps to a single banking resolution model. Barroso's proposals will give the ECB power over 6,000 European banks, including large institutions and smaller savings banks. He's seeking a single supervisor for the Eurozone, and it changes the timetable for an ambitious 1st of January 2013. Much of Barroso's proposals mirror our own, with the exception of the ECB doing the work and not the Bank of England. This, of course, refers to the Eurozone, but what happens in Europe is absolutely relevant to our interests in the UK. But however, the two key areas of change that are relevant to the UK are the Financial Services Bill and the Banking Reform Bill. The Financial Service Bill seeks to reform the regulatory structure, putting the Bank of England at the top of the pile. It has been noticeable, I think, through the Treasury Select Committee's work in terms of looking at what's been going on in the LIBOR scandal, the body language that has come from members of the Bank of England. I think there is no doubt about it that the Bank of England is corporately extraordinarily angry at having lost sort of supervision of the banks under FSNO 2000. And there's almost a sort of point where they shrug their shoulders and say, well, what do you expect if we weren't in charge? You know, how do you think we're going to avoid these LIBOR scandals? They are very pleased to be getting it back. But I'm sure you're sort of familiar with the key changes within the Financial Services Bill. The Financial Services Authority will be replaced by the consumer-focused regulator, the Financial Conduct Authority. There will be a new Prudential Regulatory Authority, the PRA, and both will be overseen by the Bank of England. This ensures that the role of regulating the financial services industry with regard to consumer is separate from that of regulating the nuts and bolts of the system. However, I do think the most profound new changes coming with the Financial Services Bill is the role of that played by the new body that sits inside the Bank of England alongside the Monetary Policy Committee, and that is the Financial Policy Committee, the FPC. The FPC is tasked with ensuring the overall stability of the financial system, essentially taking the heat out of the bubbles and protecting consumers when things start to go wrong. This is unprecedented, and it's an area that I personally have the greatest concerns over, and I'm not, I think, alone in having the greatest concerns over this. It's not to say that I think they will start to get things wrong. More to say that I think this is something that we all, as the bank and the wider sort of financial services community, needs to understand. It's important to see how this beds down. The MPC has a very single, very definable, clear, simple target, and that is to keep inflation at a very specific level. The FPC's role is much looser and much less easily defined. And indeed, we're not entirely sure how they'll do this, and the Treasury Committee is also looking at the range of macroprudential tools as part of an ongoing investigation to learn more. And they have published a book about this, and we have more investigations going on tomorrow. But again, this is something which is going to be quite unclear. Importantly, we're concerned that the governance of the Bank of England is not sufficiently robust to be able to properly scrutinise things. And we, the Treasury Select Committee, are calling for a change in governance to extend the court's role from simply a pay and rations type of control to allow them to conduct ex post reviews of decisions. This is important, as some of the controls that can be passed down to the system from the FPC are ones that will be published, and those are rules of direction. But there are other rules of guidance that may not necessarily be published, and it may be years before we know that the FPC has intervened in any particular area. That is why we need surety from the court that the work they do, the FPC does, is sound. The court must be able to review the FPC, not to be able to say that the FPC came to the wrong conclusion but through the right process, but to see why the FPC made this decision in the first place. Moreover, the single most important document to affect our banks is, of course, John Vickers and his report by the Independent Commission on Banking. The ICB has essentially come up with a number of proposals that fit into three headings: structural reform, capital loss and absorbency, and competition. Vickers is trying to address the problem of too big to fail. In doing so, he is not trying to make a mechanism that prevents, ever again, banks from failing. He is more trying to create a model where the banks can fail and not contaminate the whole system. In this sense, he sees them as a utility. Should a water company go bust, there is a mechanism whereby the water keeps flowing to the consumer. That hasn't been the case to our cost in the banks, where the government had to bail the banks out. And it is absolutely vital that we have this sort of redundancy, if you like, in the system, that the money keeps flowing within the system in exactly the same way that a utility works. The structural reform side of things is, of course, the retail ring fence. This protects the so-called vulnerable customers from the supposedly more risky investment banking operations. Essentially, UK and EEA retail activities, SME and consumer lending and deposit taking, must be isolated from the rest of the bank, with its own board of accounts and regulatory capital. Relationship with the investment bank must very much be on an arm's length basis, and any proprietary trading and derivatives trading must be outside the ring fence, although there is a little bit of flexibility on some of the derivatives activities. Capital and loss absorbency tends to focus more on the ring fence activities, and the retail banks will need equity capital equivalent to 10% of their risk-weighted assets, plus an additional 7 to 10% loss absorbing capital. The whole group, both sides of the ring fence, need primary loss absorbing capital of up to 20%, much of which can be made by the slightly controversial bail-in bonds. And the bail-in bonds come under the control of the UK Resolution Authority to decide when to recapitalise. These bail-in bonds are a sort of fairly interesting concept, because I think nobody really quite understands how to value them or how to understand how they work. There's going to be a demand for a great many of them, and it's going to be unclear exactly what the demand is going to be, especially when they have all of the advantages of being a bond during the good times, but suddenly, just when you don't want them to, they turn into equity in the bad times, and that is going to be interesting to see how the market does value them. And in addition, there is also depositor preference to put deposits insured under the Financial Services Compensation Scheme of other unsecured claims by creditors in the ahead of other unsecured claims by creditors in the event of a retail bank's collapse. And finally, of course, competition. The ICB has called for improved customer account switching processes, and we'll be seeing some of this starting from next year. There is a great deal more that can be done on this. This is a system which is coming up, which is a way of using the existing system more effectively. But there are a number of people who are calling for a new approach to the whole of the clearing system, and actually looking for a utility clearing system where you can have white label portals for banks, so that actually in the event of a collapse, you can have the customer move from one bank to another seamlessly without actually having to change account numbers and all the rest of it. However, greater transparency to allow for comparisons in terms of charges is proposed, as part of this competition measure. And this in itself may cause problems as people will suddenly start seeing for the first time ever that they have actually been paying quite a lot for their current account charges. It's just from then on going to be put on a separate basis. Certainly from the investigations we've had under the Banking Standards Commission, where we have met real consumers, they have been very, very upset with the prospect of having to pay for their current accounts, even though they kind of know implicitly that they have been paying for it for years. They just don't necessarily want to be told how much, sort of ahead of the downturn. The government's white paper has allowed some concessions in areas such as ring fencing, recognising that some SMEs may need some limited investment banking services will be better provided than the retail bank. But the trade-off is tighter regulation in group, intergroup trading. It also hardens a ring fence by placing a duty on directors to ensure the integrity of the ring fence. And finally, banks with a balance sheet smaller than around 25 billion can be exempted from these rules, and that carves out about 13% of the industry on current estimates. Similarly, with regard to capital, the white paper gives a break to non-UK and EEA activities which pose no threat to the region, and to stick with the Basel III requirements, not a higher Basel leverage ratio. Now, Lickenham, which only published I think early last week, however, proposes a different set of rules, and these need to be watched as well. Ring fencing is done on a slightly different way, taking proprietary trading and other risk activities out of the bank, and ring fencing inside a standalone body. Vickers protects the consumer from all the sort of the dangerous stuff. Lickenham protects everything else from proprietary trading, and that's kind of the essential difference. It's an interesting angle and goes sort of slightly closer towards the Volcker rule, as a bank would not be able to use customers' liabilities for trading activities, nor take advantage of any explicit guarantee to secure cheap funding in order to do that proprietary trading. And much of the other stuff with Lickenham is similar, but Lickenham does highlight boards of management, risk management, perverse incentives through compensation schemes, risk disclosure, the sanctioning powers, etc., and seeking to strengthen each of those areas. And we are, as a result of this, in a period of, and I think this is incredibly important, we're in a period of very serious regulatory churn. Add to what I've described, the myriad of stuff coming through from Brussels, and you see that this is an uncertain period for the financial services industry as a whole. We've already seen threats from some of the big banks to up sticks and leaves, and there are some people who think we should call their bluff. But I see what we're doing now as a period to ensure that we have a robust but fair regulatory environment going forward. Not at the time for brinkmanship with over 10% of our tax receipts. We mustn't forget that our financial services industry employs over 2 million people, generates around £56 billion a year in tax receipts, and comprises around 12% of our GDP. And that is why the work of this Parliamentary Commission on Banking Standards is so important. It's certainly not for me to either prejudge the outcome of the Commission, or indeed to prejudice my involvement with it with a careless comment, but I can show you some of the work and what I see as important. The Commission is made up of 5 members of the House of Commons and 5 of the House of Commons, all under the chairmanship of Andrew Tari, who is the chairman of the Treasury Select Committee. And it's operating in a broadly similar manner to that of the Select Committee, with 1 or 2 changes. We can use counsel to do some of the investigations. But we also have subcommittees, so instead of having sort of interested groups coming in front of the entire Commission, the subcommittees will go out and do specific investigations into certain areas. And they're trying to seek out in-depth knowledge and actually work at a lot greater granularity to find out about what's going on in the system. Part of our work is to do with the pre-legislative scrutiny of the banking reform bill. But once that's completed, the main thrust is to look at the banking industry as a whole and to help restore trust between the banks and the communities they are there to serve, be they individuals, SMEs, or multinational conglomerates. Now, I mentioned earlier the 4 areas that suffer from Big Bang: the merging of risk business with consumer-related business, the complexity of the regulatory system, perverse incentives, and shareholder involvement together with corporate governance. And each of these areas is a debate in itself. The ICB has come up with ring fencing in terms of trying to separate risk business from consumer business. And that is a technical risk-based point. But in looking at this, the part of this debate has to be the question, which part of a bank is virtuous, serving the public interest, and which is self-serving, merely seeking to enhance shareholder return? The fact is, I think it's important to keep remembering this, the banks do an incredibly important job. They are the oil pump to the engine of the economy, where money is the oil in the engine. Without the banks reallocating money from where it has accumulated to where it is needed, the engine of the economy seizes up. There is no better distribution model of money to where it can do the most good than through the banking system. The investment banks are part of this function, and they add to this with the ability to raise tradable debt and equity on behalf of British and global businesses through the equity in the bond markets. Their market-making functions provide liquidity for investors, and research departments analyse opportunity. The reality is that the banks create indirectly millions of jobs, and I don't think the banks do anywhere near enough to try and highlight the fact that they are actually, in some cases, quite a virtuous organisation. But alongside this, they seek to enhance returns by trading their balance sheets, and this is not a virtuous thing to do. Indeed, some will be loss-making were they not trading their balance sheets, so does this possibly suggest that we need a period of consolidation? In an ideal business model, the interests of customers, shareholders and staff should be equally balanced. Identifying those parts of the banks where the customer is irrelevant should, I believe, be the basis to deciding which part of the bank should be isolated from the other parts. Inevitably, with an international marketplace, regulation will, in seeking to cross borders, become very, very complex. But we have lost, in our enthusiasm to regulate, something possibly more important, and that is a professionalisation of banking. No longer is staff required to sit banking exams. They simply need to pass an FSA-recognised exams to make sure that they are capable of dealing with the public. The new Chartered Banking Code of Professional Conduct starts to address that point. Having a qualification that can ultimately be a necessity for a career, combined with the continued professional development, means that they can build up an ethic of excellence within the industry. It would certainly mean there are sanctions against employees who break rules, prohibiting them from practicing as bankers in the event of a serious infringement. It's a common complaint that no one has gone to jail after the banking crisis, or even been barred from working in the industry. But the regulatory simplification would also help smaller banks emerge into the marketplace. The cost of compliance is huge, and more so to the smaller institution. There are around 48 smaller banks out there that are independent of the big groups. Yet as a result of the banking crisis that they were not involved in, they've seen a significant increase in the regulatory burden and cost. For new banks, this has meant that it is now incredibly difficult for them to break into the marketplace. There's an example by the fact that if you go to the FSA as a potential challenger bank, seeking a pre-application hearing, you are going to be spending something in the region of up to £1 million, if not more, just to get to the front door of the FSA to start the process and the formal application to open a new bank. And we've only seen one new ab initio challenger bank come into the marketplace in the last. I've been using the term 100 years. Apparently, it's since 1834 was the last new banking license, and that's Metro Bank. There is, I believe, one more on its way. But having spoken to some of these people who are looking to do this, their approach is that had they known it was going to be so ferociously complex, they would not have done it in the first place. But help for challenger banks and a clear mandate for both competition and competitiveness for both the FCA and the PRA are certainly very, very desirable. And there is a movement in the House of Lords to try and get that into the financial regulation law. I mentioned earlier the cross-contamination between the wholesale investment banking sector and the retail banks. And there's been much discussion about incentives for investment bankers, and I've already argued the case for matching reward with personal risk. The FSA have done some useful work on this, and their guidance consultation on risks to customers from financial incentives goes far to shine a light on this area. But the latest scandal of SMEs being sold so-called interest rate swap derivatives illustrates how this cross-contamination has permeated the industry, especially in the area of incentives. Prior to the crisis, as we wallowed in the midst of the colossal lending bubble, margins on lendings have become so wafer thin that there was little to be gained from the bank by simply lending. So the bank sought to maximise the opportunity of this relationship with the customer to develop by striking a lending deal with the customer. If you look at the example of huge corporations such as oil exploration companies, these companies are used to complex financial deals, and part of those deals are interest rate derivatives used to limit their interest rate exposure. But it is one thing to be the chief treasurer of BP or Esso. It is another to be a small business owner seeking finance for a project. Facing small businesses pre-crisis was a local relationship manager who would be competent at lending, but not much else. Once a lending deal was agreed, it was, it emerged, often the case that the relationship manager would then introduce the concept of an interest rate hedge. At this point, the relationship manager, not qualified to discuss derivatives with a non-professional customer, would pass on their client to a more senior, centralised derivative salesman who didn't have a long-term relationship with that customer, who would then construct a bespoke derivative hedge for that SME customer. The lending deal would then become contingent on taking out the interest rate swap, and what had started as a zero margin loan for the bank then became a high-earning derivative trade. Indeed, so high-earning it seems, the relationship managers would be awarded the highest level of bonus for loans tied to interest rate swaps, and these bonuses would be booked at the signing of the deal, not over the lifetime of the loan or the swap. For the bank, money had been made, but for the high street relationship manager, who has possibly come from a period when you had a long-term relationship develop, that individual had crossed the divide from seeing customers as long-term relationship to the benefit of everyone's interest, to being seen as almost a mark, an opportunity to sell a deal and to be able to make enough money to put a deposit on a brand new Audi TT when your Christmas bonus comes through. And we must also look at the involvement of shareholders. I've already described the Lloyd's effect, where the interests of shareholders are best served by the ability of a management team to engage in pro-cyclical management style. RBS and Fred Goodwin were the darling of the city when the times were arguably good. Lloyd's was seen as too conservative. But come the crash, the perfect hedge should have been short RBS against a long position in Lloyd's, were it not for the devastating decision by Lloyd's to buy HBOS. Did Lloyd's buy HBOS in response to many years of being seen as by shareholders being not looking to seek advantage? Was it Gordon Brown who persuaded Victor Blank to invest and Victor Blank took the advice? I don't think any of us will really know, but the question of shareholder involvement is complex. Investment managers own shares on behalf of other individuals. Direct shareholders own shares through nominee accounts. And this means that it is often incredibly difficult for companies to be able to communicate with their shareholders. Even big investment managers are frequently running many different smaller funds. Should the investment manager, acting on behalf of the end beneficiary, speak on behalf of all of the funds, or should each fund speak alone? And is it in the best interest of a fund manager to hold on to a position that is performing badly in the hope that shareholder intervention and advice to the board will turn the position around? All this points to shareholders continuing to take active involvement with their investments through stockbrokers, not voting at AGMs, but voting with their feet and giving orders to buy or sell shares. Yet without the shareholder involvement, who will govern the governance? Non-executive directors are answerable to shareholders. If the shareholders are silent, the non-executive directors can effectively do what they want. And even when we do see shareholder involvement, such as this year's so-called shareholder spring, it is not about the strategic direction of the company, it is about the manager's pay packets. The important question is this: are shareholders knowledgeable enough to be effective contributors to management decisions, especially when you're looking at complex institutions such as universal banks? We are, of course, asking a lot of our banks. We are asking them to lend, but we're asking them to shrink their balance sheet. The consumer sees the banks as lending irresponsibly, but does not accept responsibility for being an irresponsible borrower. The previous government is doing everything it can to place the blame of the crisis on the banks, but will not accept any responsibility for their part in the regulations that allow the crisis to develop. We're also asking a lot of regulators. We're asking them to ensure that the banks are never too big to fail, but in so doing, we're inadvertently allowing them to place barriers resulting in the notion of too small to start. Account portability is a huge issue, but if accounts are too portable, a bank could potentially be destroyed in minutes as a result of a destructive Twitter campaign, and that's a balance that we need to get right. I mentioned earlier that we're in the middle of a period of high regulatory churn from both the UK and from Brussels. At the end of this, we must resolve the too big to fail issue. We need to avoid giving the banks a competitive head start with the implicit guarantee that recognises some sort of long stop standing behind the banks. We must preserve our position as the world's leading financial centre, and we must ensure that our regulatory regime is seen as the finest and safest in the world, combining this with our world-class legal system to ensure that investors the world over will always see London and the UK as the safest and best place to locate their financial assets. It's worth remembering that whilst the Americans in Wall Street, 20% of the financial assets under management in America are international. In London, that number is 55%, so we are still a destination for huge amounts of international capital. In finishing, I'll share with you a conversation. I was in a meeting with a number of bankers last year, and in a rather forlorn way, one of them asked a question. Every day, he said, we see ourselves being derided and castigated on the front page of every newspaper. Do you know what that's like? It was a pretty old question to ask a politician. When we have secured the points I mentioned, there will, I believe, be one test of success. When we as a society start to see the banks as one of our finest assets, if not our finest asset, and realise our financial service industry is the envy of the world, we will have succeeded. And when those people who work in the banking industry can hold their head up high and say with pride, I am a banker, then we will know that the best form of regulation, internal peer pressure, and a desire by all to be involved to maintain a high level of excellence will finally be looking after all of our interests. Thank you.
Mark has very kindly agreed to take questions.
Thank you, Ian Perro. What really worries me as someone who works in banking and financial services is that the industry could go the way of the motorcycle industry in Britain in the 1960s. How can we prevent ourselves losing that preeminence in banking and financial services to some of these other financial centres like Singapore, Beijing, Hong Kong? You can see it happening all the time. And it's a big worry. You know, we've got a fantastic industry, but if we aren't careful, in 10 or 20 years' time, we'll look round and people will say, oh yeah, what happened to that? UK was the preeminent financial centre in the world. Just like we were with motorcycles and manufacturing in the 60s. It went because of too much regulation, too much tax, too much interference from government, and so on. And that really worries me, and I think that's a big issue that we need to think about in the next few years.
Very good question. It's very interesting you choose the motorcycle industry by way of comparison, but I think part of the reason why it all went to Japan is so that's why they make motorbikes and they can do them cheaply, which we couldn't necessarily do, although we make the finest motorbikes in the world. I think we have to look at our financial services and banking industry sort of holistically. It's not just about the banks. It's about our legal system, it's about our position in the world, it's about our attractiveness as a place to live. And so that includes our tax system, our personal tax system, as well as our corporation tax system. As I mentioned at the end, 55% of international financial assets, 55% of the financial assets based in the UK are international. And people are bringing their money to this country because we have a regulatory system that they trust, and we have a legal system that they trust. And irrespective of where the actual bankers are themselves, it's that framework that is the most important thing. What we've got to do is be incredibly careful that in reforming the banking system of the banking regulation, we don't do anything that is just too stupid. We don't do anything that is just liable to sort of push this offshore. You know, we, on the Treasury Committee, we get a lot of these big banks coming in, and we're regularly asking them the question, you know, are you going to move offshore? And quite a lot of them actually take rather to answer the question, which usually means they're certainly thinking about it. And HSBC came in a couple of years ago and I asked this question. They said, well, every 3 years we go through this process of deciding where we're going to base our domicile, and normally we keep it in you know, we keep it in safe. A year later, Douglas Flint came back again and I said, you know, last year we had this conversation, what have you decided? And he said, we've decided to roll the decision over a year. And that's quite a worrying thing. They're clearly not decided that they definitely have to be in London. But an organisation that has come from the Far East into London for a number of different reasons, including the worry about China, then that is something which is you know, we need to be concerned about. So we have to get that balance right. But exactly the same way as your analogy with the motorcycle industry, we also have to be incredibly mindful as to what's going on in our competitive areas. And you're right, Singapore, a lot of people do Singapore. We are seeing something else, which is much more difficult to see, and that is stuff that's not coming to London, that might have come to London. And this is certainly some of the hedge fund managers are not coming to London. New divisions within investment banks are being set up not in London, they're going elsewhere. And part of that is looking for a better tax break for the individuals who don't want to pay 50% and 45%. And part of it is the fact that actually you can get a bit of cheaper regulation, certainly if you're doing business-to-business type of stuff. You don't necessarily have that high degree of regulation. But it's an incredibly important point, and one which is absolutely at the forefront of all our minds, is how do we ensure that we don't, as you so rightly say, wake up in 20 years' time and discover not just we've lost the pride of work, but also we've lost 10% of our tax receipts, because clearly at the time when we're trying to sort out the financial mess we've inherited, we absolutely need the income from the banks.
David Potter. It seems to me the reason this became such an issue was the too big to fail issue. That was the thing that really brought, the big banks to the attention of politicians, the public, and so on. And I don't think any politicians have been radical enough in saying, hang on, we spent the last 3 years trying to stop banks that are too big to fail from failing. And that's all you've been doing, because RBS is still too big to fail. So is HSBC, still too big to fail. Meanwhile, we identified at the CSFI 40 new financial service businesses, platforms, Aldermoors, small banks, Metro, people trying to get in. I spent a year and a half trying to get a new bank off the ground. Everything is stacked against you. The logical conclusion is the way to stop banks being too big to fail is to make sure that they're small enough that it doesn't matter if they fail. And it doesn't matter if a £20 million bank fails. It really doesn't. And I don't think you guys are being radical enough. I think you're playing with the same concepts of if we regulate enough, we'll get it right. You never will.
I wholeheartedly agree with you. I think a situation where we can lose half a dozen banks without anybody really noticing is exactly what we want to be in. You are going to get the big banks, and the intention is to try to get a situation where there's a resolution where you can allow the bank to come out elegantly without taking down the system with it. But there's always going to be a supposition that there's too big to fail. There's always going to be an inherent guess that if you are an enormous bank, and of course what it comes down to is what you have to pay for funds in order to borrow on the impact market. And there's always going to be a supposition that if you are a very big bank, you are less likely to fail because there's going to be more, even if it's not capital from the government, there's going to be more effort from the government to try and resolve you in order to keep you going, if that means sort of support from the regulators or whatever. So it's going to be a very, very difficult one. I did go through a thought process which looks at the idea of, is this implicit guarantee such a bad thing? Is it, you sort of hypothetically, does it matter that there's this implicit guarantee? Because actually only 13% of the banks are outside what is implicitly guaranteed. And therefore, if the taxpayer is ultimately insuring the banks, and the taxpayer is also the customer of the banks, the taxpayer is getting the benefit of it both ways, as long as you back them with a big bank. So is that a bad thing? And having gone through that sort of thought process, I came to the conclusion actually it still is a bad thing, for the simple reason that it does prevent challenger banks coming into the marketplace. And it's not just challenger banks that provide an alternative like Metro Bank, it's also banks that want to come in to provide niche banking. And there are certain areas of niche banking, be it SME banking or private client banking or whatever, where you need that opportunity to be addressed and the market opportunity to be taken by people. I'm 100% behind what you said, absolutely 100%. And it's really a question of us backbenchers and the Treasury Committee and those of us who are championing this to try and turn the oil tanker in a way that actually we end up with a lot of challenge banks. But as I said, we have 48 really small banks, and the smallest one that I've seen is Kingdom Bank with a £50 million balance sheet. There are an awful lot of these small ones. Aldermoor Capital is a very good one you've talked about, which is a new one that's coming to the marketplace by buying in another banking license. They seem to be doing quite well. Metro Bank seem to be doing quite well with retail offering, and doing it by the simple business of just offering a good quality client service to the point where you feed your dog while you're opening an account. So it's that type of old-fashioned service which I think there is a demand for. But wholeheartedly agree. And actually, I'd be very interested to hear about your experience afterwards.
Richard. Richard Sharp. On this last point, first of all, the too big to fail, we were caught by surprise and defended bondholders when we shouldn't have defended bondholders. We have the capacity within the balance sheets of banks for banks to fail to the consequence of those people who achieved a superior return by lending into the capital structure underneath the depositors. And so clearly, that we can then have large organisations as against being concerned about large organisations, and we can have large organisations that then can fail. Because the point that you raised was related to financial new entrants for the UK. But the UK as a whole benefits from having global organisations here, where we have a comparative advantage as a nation. And I think this point you made, an incredibly well-balanced talk, about our national interest associated with the successful financial services industry here and the spillover effects, is enormously important for the nation in terms of its revenue, for its employment, and for other services, and needs to be articulated, as you said, in the context of politicisation. I'd like to come back to this point on governance that you raised, both with respect to the Bank of England and the banks themselves. Because there is a risk in the rhetoric of populism, which is anti-banking and financial services, which doesn't take account of the larger shared interest in success, that the regulators themselves, including the Bank of England, pile on in an uncommercial way. And hopefully, as a result of the work that you do, we have both the appropriate regulation, but we also don't get over-populist reaction by the regulators, which actually work against the national interest. And I wonder if you can comment on that.
Quite a complex question. I think the good thing about the regulator is that the regulator is a standalone organisation, and having got involved with trying to persuade the regulator to do something on the retail distribution review from Parliament, it was quite extraordinary how dogmatic they were when we were trying to talk to them. And I've been in the press being quite rude about it, but actually, it's my view on the role of the regulator being standalone is that actually it's the right thing. It's incredibly important that any regulator is not influenced by a bunch of MPs who are suddenly piling in at any given time, or indeed the press piling in at any given time. Because if you think you've got bad regulatory churn now, imagine what it would be like if the regulator was responding to every single sort of backbench business debate in the House of Commons on RDR or whatever it happened to be. We would have an appalling amount of churn going on, and nobody would really be able to tolerate what's going on. And I think the independence of the regulator is incredibly important. But there certainly seems to be evidence that the regulator is responding to populism in terms of things like the experience you would have if you were trying to set up a new, smaller challenger bank. Because although the regulator, in theory, will go through the process, and also say, yes, we'll be delighted to take your application in and give us whatever it is, and we request the bank, you can have a bank license. The reality of it is ultimately you come down to an individual who then has to put his name on the bottom of an authorisation process. And that individual is, I think, probably quite terrified that they may find that their name being on the authorisation of a bank that subsequently goes bust in the future. And there's no reward for the regulator introducing more banks, but there is a lot of negatives if they authorise a bank that subsequently goes bust. So the regulator is on a kind of a lose-lose situation. I don't know what the answer is, actually. I mean, you've been quite familiar with the problem. I'm not entirely certain how you go about trying to resolve that. The press is pretty robust. It's pretty robust with politicians, it's pretty robust with bankers, it's pretty robust with regulators. And certainly, whenever you're trying to get something in the press and sell newspapers, the best way you can sell a newspaper is having a scarce community story, and that's kind of well known. So the problem is they will always come out and they will always talk about how regulators fail. But at the end of the day, I suppose to a certain extent, whilst making sure they do the right thing, we have to protect them so they don't get dragged too far down the too heavy approach to it. And that also goes with corporate governance. You want to have very, very good people who are prepared to come into banks. I mean, I think it's very, very marked when you take someone like Stephen Hester, who has been brought on very much as a solution to the problem. He's been given a very clear job. He was brought in after our this went bust. He was paid a certain amount of money. If he gets paid £15 or £20 million over 5 or 10 years, and we get back as taxpayers £46.2 billion, I think that's probably quite a good return on our investment. And I think we shouldn't be rude about it. I think that from a personal point of view, he's clearly, I think, an intelligent, articulate and sensible bloke who is instilling what we need, which is a culture of excellence within that organisation. And he works incredibly hard. The problem is every time something goes wrong, which is way out of his control, like the IT system goes down, it costs him personally £1 million. And I think that this endless, people had to give up the bonus because of all the negative press. And I think this whole process of banker bashing is is, to a certain extent, you've got to have scrutiny. You've got to have scrutiny of what they do. But I think we are taking this too far. And the thing that I want to get out of Banking Standards, which is a ballot report that finally brings about sort of truth and reconciliation. So I genuinely mean that when we get to the end of this, bankers can be proud, it will be an honourable profession to go into, and then we will have the right type of people going in at every level in order to instill good standards. But if we continue to bash it, we'll never get that.
And should bondholders have been blurred out?
Exactly. No.
Perhaps this is a good time to ask you what you think of Glass-Steagall.
I'm going to grab my bit of paper because, of course, we've got Volcker, Lickenen, Vickers, Kay, and obviously the banking. We've got Paul Volcker coming in on Wednesday, and I think he has said that Glass-Steagall was what they didn't want, and actually he's now decided that it's not what they should have. Again, there's a lot of variation between the. I think Glass-Steagall is something which is past, and we're now looking at the new thing in the future. But I can give you a bit of an idea about what's going on. Volcker basically completely excludes any business which has deposits from deemed on a saving account. So it's quite a hard thing. Lickenen, and it's quite a strong sort of good to do with. Lickenen essentially says ring fence those sort of risky businesses. The Treasury kind of allows a bit more into it, and sort of essentially says you can't make loans to the financial firms from the ring fence banks. Vickers, you've got simple derivatives which the hits lose. You get to K, John Kay, which is the most simple one, where you go to a sort of completely narrow banking system where you only do sort of deposit taking and simple narrow banking. So those are, if you like, the kind of the levels of the separation that you have. Is it a good thing, though, I think what you're asking, to ring fence or to separate bits off? I come back to this cultural thing. I really do. You know, we can talk at a huge amount of length about the technicalities and the risk here and the risk there, and all of this is incredibly relevant, and I'm not diminishing it. But I still come back to the fundamental cultural point, and that is the trying to balance the three interests of any commercial organization, and that is the interest of the shareholders, the customers, and the staff. And I strongly feel that those ought to be balanced. You need to balance that in order to get a good, sort of viable, socially helpful, useful institution. If you have an activity which does not take into account the interest of customers, but does shareholders and staff, which balance sheet trading does, then I would question whether that is instilling the right culture into an institution. And I think it comes down to that cultural element. But we can argue, actually ad nauseam, about the rights and wrongs of little bits of risk here and little bits of risk there. And I think all of these arguments have got their merits and their detractors. But what I think is key is we come to the right cultural conclusion. But answer your question.
With Forrest hands, which was very pleasing. Can we take two questions there?
Thank you. You referred to what's socially useful, and it seems to me the long-term future of banks does depend on their being. Sorry, my name is Richard Bacon. The long-term future of banks does depend on their being socially useful. And it's hard for me to see what was socially useful about Goldman Sachs manipulating the Greek national account so that they could get inside the euro. In fact, one might arguably call it treasonous in terms of the consequences that it's had. And so I'd like to ask you about how you think banks can most endeavour to be socially useful. And going back to what a colleague said earlier, isn't it the case that so long as they are big, that will never really be possible? I think of the friendly societies, the building societies that were set up for the most philanthropic of purposes to allow people to buy their own houses, the building societies in the 19th century, which were very successful, and which through a demutualisation campaign that was largely driven not by the need for capital, although that's what they said, but largely by greed. Because when you were chief executive of a bank, your salary had to double immediately compared with what you'd been on before. Many of those institutions, Alliance and Leicester, Bradford and Bingley, Halifax, Northern Rock, were destroyed within 12 years. And their socially useful role has gone as well. There are a lot of people here who I think are bankers, and many of them sound still shell-shocked that bankers are objects of hate. Now, I don't find this surprising at all. When you hear on the radio that Goldman Sachs behaved the way it did, when you hear on the radio that HSBC had a chief executive who apologised for mis-selling of personal payment protection insurance and endured a £30 million fine, these are things that people care about. I have a constituent in my South Norfolk constituency who is a multimillionaire. He runs an extremely successful business with a 40-year trading record. And this year, he went to his bank asking for a trading facility, which he has. Basically, they went to him, I think, asking for a change of terms. And every time he went through the terms that they asked for, every time he jumped through their hoops, they said, no, we didn't mean this hoop, we meant this hoop over here. So he jumped through that one as well. And in the end he got so sick of it, he said to his clients, who because of the business he's in are very wealthy, I'm sick of this, I would like to set up a facility with you, my client, and I've got assets here, you can have the deeds to the following building. And they said, sure, we'll come in on that, because the rate you're offering is much better than the banks are offering. That kind of disintermediation couldn't happen if the banking system were working properly. And isn't it the case that instead of 92% of personal accounts, 88% of mortgages and 86% of business accounts being held by 6 institutions, we need to smash, and I do mean smash, into small pieces the industry up, not because we hate banks, but because we want them to work properly, be socially useful, and last in the long term. And it's not going to happen without something pretty radical.
I was going to be a bit simpler than that. Going back to your original early comments about the need for simplicity in regulation, your comments about the need to achieve balance between 3 aspects militates against simplicity. If you separate totally the simple lending borrowing bit from what once upon a happy time were called merchant banks, you don't regulate the merchant banks. It is caveat emptor, get on with it, and they used to go bust with some frequency, but the better ones didn't. And the other lot, which we support, can go on being boring, which in its better days Lloyd's was, until Victor Blanc destroyed it. Separation. And support only the socially useful bits, although in my opinion it is not the job of banks to be socially useful.
Well, in socially useful, I'm not necessarily trying to suggest they're sort of running around sort of seeking ways of being socially useful, but actually what they've got to do is a job that they're there to do. And I come back to this point where there isn't a better mechanism for distributing money from where it's accumulated than through the banking system to where it is needed. And that's the social value that banks have, is being able to perform that function. And we have to have it. I mean, we are, well, I say we, I mean, there's the attempt to sell the RBS branches, which obviously fell through over the weekend, and then of course we've got the branches which are bought by yeah, exactly, right, that's right. So there's various things going on, and then of course we've seen Virgin Money buy into Northern Rock. So there is a bit more going on, but I completely agree. I mean, I think that we need to have a sort of society where we have a lot more banks which are doing the old-fashioned banking thing, which goes back to a model which is more familiar with sort of Captain Manning. I mean, I think we're long past Captain Manning. We can't necessarily go all the way back to these kind of sort of halcyon days when everything was actually fantastic, because actually it was, these bank managers were pretty intimidating, and we want people to have confidence to go and set business up and do progress and go and do useful things. There are smaller organisations being set up, these sort of social collective groups of lending which is going on, and it may be interesting to see how this business bank with Vince Cables is going to work, and see if that actually does anything worthwhile. So I just sense there's a prejudgment on that one. It's going to be interesting to see, but it's that type of thing that may provide sort of more challenging coming through to it. But it comes back to, I think, to the effect the regulator has on the bank in order to allow them to do it. So you were saying separate the bank, so you only regulate the bits that need regulation, i.e. the bit which is dealing with the consumer, and let the sort of the business banks, the investment banks, sorry, not the investment, the merchant banks actually, get on with doing that. That may be an answer, but I think But at the end of the day, if we want to be, and this is the other point, we want to be a preeminent global financial centre, if we were to ask the banks to do that, then the big universal banks wouldn't want to come here necessarily, and we have to balance the two sides of that.
Question at the very back.
Yes, thanks. Wouldn't it be better to do something very simple? Appoint a new chairman of the UKFI with instructions to split up my ex-employer, Lloyds, into its 4 natural components, Lloyds, Halifax, Bank of Scotland and Scottish Widows, which gets the 3 others away from the ghastly mess in the Bank of Scotland, and split up NatWest into NatWest, RBS and ABN AMRO, where the garbage is. Then you have very happy staff in most institutions, and you have some chance of having some competition.
Well, fun enough, we have the chairman of UKFI coming into the Treasury Select Committee next week. I will ask him exactly that question, watch Channel 81 and see what his answer is. But it's not an unreasonable proposition, not least because, of course, the IT systems in between all the banks aren't necessarily compatible, so there's a huge amount of problems. So actually it would be better to do it now while they work on their independent IT systems than it would be to last time. But I will definitely ask that question.
We'll just take a couple more questions there.
It's Edward Wakefield. The only trouble about all this very well-meaning discussion about splitting up all the banks into small pieces is that actually when it comes down to thinking about the customer, actually the inevitable cost of it is to make the cost of finance and the availability of credit much more expensive and much more restrained effectively. And it is well-meaning, but frankly, the Metro Bank, the example here, is a loss-making so many of the smaller banks. Banking is a game of scale, and people providing capital are not going to change their return expectations and so on. So to the extent that we increase adding, capital requirements and so on, and indeed it may be the right thing to do from the point of view of safety, it's not necessarily the right thing to do from the availability of credit. And I just wondered what the committee's view is on the customer from the point of view of credit and cost.
It is a very fair question. I mean, you do have the economy of the scale, and if you do start ring fencing the banks, you're immediately going to start seeing costing up to the consumer. It is a big problem, and it comes back to this implicit guarantee. The implicit guarantee doesn't necessarily have to be with a bank with the government standing behind it. There is the economy of the scale where you know that a big organisation has much more sort of counter-cyclical elements within it, so that they will actually be more robust, whereas a smaller bank may be more fragile, dependent on something in the economy elsewhere. And that will mean that a smaller bank will have to pay higher for funds than a bigger bank. It's not the same for everybody. It's a difficult one, but the answer to that is that there are a lot of banks out there that still do okay. People like C. Hall & Co., who I used to bank with until they put their fees up to £65 a month, have had an increase in their cost, and they are an outstandingly good old-fashioned service bank. And they have a customer base based on the fact that they give a very, very good service. And there will always be a demand for that type of thing. People will be prepared to pay for that sort of banking service. But what is important is that in the regulatory regime, we don't do anything foolish, which means that they have extra costs loaded onto them because they're small. We keep the costs fair to them, not punitive costs, which means that the consumer will be disincentivized to the extent whether they move to go elsewhere. And there are other banks coming into the market. People like Handelsbank are making an extraordinary inroad, but obviously that's because it's coming in underneath house-building in from another bank, so it's got a big backing. But I think we just, if there is a charge and if there is a cost, then it's up to the bank to be able to see if they can win business on the basis of excellence. And I go back to this thing right at the very beginning. We talk about the competition between stockbrokers, pretty big bank. It wasn't on price, it was on excellence, because the price was all the same. Now we're never going to say the price is the same.
You're a great example is you weren't prepared to pay for service yourself.
Yeah, I know. But there's a price that I was. It was 25 quid that I was, and 65 quid I'm not. Yeah. But it's an important point. But some people still are. They're still going. They've been around for 325 years, and hopefully they'll be around for another 325 years. Nobody there here from Paul's on.
And the final question, just
Good evening, Sam Cook. We gave a very comprehensive exposition of domestic developments and also touched on developments in Brussels. I'll be interested briefly to hear your thoughts on how those might interact in the coming years. Because the fact is that many of these decisions might be taken out of our hands. That's not necessarily a bad thing sometimes. A degree of international harmonisation can be in the interests of industry, but to what extent should we be prepared to sacrifice control for the sake of uniformity?
I mean, one of the biggest complexities facing all of our financial services industry is the fact that you've got it is a global business, and the problem facing banks is that they are individually global businesses, and they are having to comply with a huge raft of regulatory regimes around the world. And you're absolutely right. I mean, if we want to be part of the single market, then to a certain extent we're going to have to accept that we have to take all this stuff from Europe. What's quite interesting, and I'm sure somebody will pick me up on this, but having spoken to a number of our MEPs with an interest in financial services, it seems that when I speak to the people here, they say it's terrible the stuff that's coming from Europe. But when I speak to the MEPs, the same people are saying actually this stuff from Europe is not bad. It does give us, it's worth doing this so we have the access to the single market. The international complexity makes it very, very difficult. I mean, even if you look at American banks alone, they have 5 regulators they have to deal with in order to implement things like whole. And it's incredibly difficult for them, or for any bank, to get this sort of international perspective. Wouldn't it be a wonderful world if we all had one set of regulatory systems around the entire world and we could do all that? And it was written by us in the UK. I'm afraid it's not going to be the case. Yeah, no, that's the important part about it. We don't want to remove it. We do have to cast an eye to what's going on elsewhere for 2 reasons. The first is that it's compatible and that we don't have conflicts with what we're asking of people. And the second is that we are providing the best. And it's incredibly important. We're going to continue to get that international capital coming into our country. We have to be the best regulatory regime that people feel the surest about. And that's key.